Welcome back. Well, Seven West Media has posted a full-year loss of around $70 million as it wrote down the value of its magazine business. For more, Sky News business reporter Nigel Freitas spoke to the new Seven West Media boss, Tim Warner, delivering his first annual results as CEO.
Tim, you've been trying to talk up the results this morning, but looking at it, there's a net loss there, a statutory loss of $70 million. What exactly has gone wrong for Seven West Media this year?
Nothing's gone wrong. That's part of an impairment charge. We impaired our magazine mastheads. Actually, it's a very strong result in what was a really tough year.
If I look at the actual figures, though, revenues are down in all segments apart from TV, and profits are down in all segments, or earnings are down in all segments, in fact, across the board compared to last year. So is it really a strong result?
Well, we think it's a strong result. The market will be the ultimate judge of that. In the end, television accounts for by far the majority of our business. The print businesses, I think it's widely acknowledged that they are structurally challenged. Less so. The West Australian has done a great job of holding up in terms of circulation declines. They have the best numbers in the country. Having said that, we know it's a rabbit-proof fence, not an internet-proof fence, and we're going to be future-proofing that business and making the plans to do that. In terms of the magazines business, again, widely acknowledged that it's a tough advertising market. But I think that's why actually we returned a very strong result.
On the TV side of things, you did have a strong performance there, 40.4% of the advertising revenue share. How high realistically can it go from here, though?
Well, our goal is to take it higher, obviously. No one's got a crystal ball, and the fact of the matter is it becomes harder to bite, scratch and glean that next fraction of a share point. But we're doing it. People have been saying now for quite a while, how long can you sustain a 40 share? We're still doing it. That's our aim. If we keep returning the sort of ratings that we are with our television channels, we're a good chance of doing it. These days, it's not about just selling 30-second spots. Generating a good revenue result is about all kinds of ideas. It's about integrating your advertisers' messages into your content. We've been the leaders in that space, and we intend to keep leading in the space.
On the print side of things, you did mention those declines are structural, which means that there's not necessarily much you can do apart from managing those declines. But we have seen some businesses now opt for demergers to remove non-performing assets. Is that something that you've considered or are considering?
It's not something that we've considered, but you know, we wouldn't rule out anything. But you know, in terms of, I've only been in the job for a month, so in terms of my own thoughts, I'm pretty focused on getting the businesses that we have in the best possible shape that they can be for the future. You know, that's going to take a few changes, but the management team is very aware of that, and we're setting about executing.
Now, your predecessor, Don Volti, said that he had no emotional attachment to any part of the business. Is that a philosophy that you also share?
No, I don't. I am quite emotionally attached to the business. This is a storytelling organisation. You know, I come from a storytelling background, so whilst I do have an emotional attachment to all the businesses, you know, that doesn't preclude us making the moves that have to be made to future-proof these businesses.
On the digital side of things, you've pointed out that Yahoo has a monthly audience of around 8 million people who engage with that particular portal. But the key factor there is how many of those customers are being monetised. Are you happy with the performance of that particular business?
We need to do better, and that business is aware of that. We've had some technological challenges there that have meant that we haven't been able to get as much video or as much inventory in that video. We've now overcome those challenges, and we can expect improving results from that business.
Where do you see growth coming from over the next year?
Well, I think we're going to be working at growing revenues in all our businesses. I mean, you know, it's that simple. It's still tough. We've seen some growth with election spending in recent times, and it hasn't been confined to election spending. But as to what happens after the September the 7th, we'll see. You know, what we're after is a clear winner with a clear vision for Australia. And I think if we get that, we can reasonably expect a bounce in consumer sentiment. That will be good for all our businesses.
So if we then look at the Seven West stock, you've potentially got your TV revenues that have peaked, you've got structural declines in both print and magazines, and then you've got the NBN coming along, which some people say is going to kill off or destroy one of the key pillars of your strategy, being live sport. Given all that disruption, why should shareholders invest in a stock like this?
I don't really see that the NBN is going to destroy live sport. I mean, in the end, that's why we're seeing such big sums paid for live sport. Securing the rights to live sport is going to be a critical factor. There are three planks to our business, and I think they're all not only NBN proof, but actually the NBN has we have the opportunity to enhance them. The three planks are pretty simple. Live sport, you've mentioned one of them. Live news and public affairs, particularly local news, is going to be key. And then probably above all those is the creation and control of Australian programs. If you're creating and controlling your own content, the negotiations for the rights on that content are pretty quick negotiations. That's what we've set about doing over the last 6 or 7 years. We're now making more of our own content than we ever have, and we intend to grow that even further.
Seven Boss Tim Warner speaking a little bit earlier today. Look, it's been a big week for media companies in terms of their reports. They'd get across some of the key ones. Evan Lucas from IG in Melbourne joins me now. Let's just start from Seven West, hearing from the boss there. How did shares react to their earnings?
Yeah, very interesting to sort of hear what Tom Warner had to say. The market's actually quite liked what West Media's come out with today. They're up roughly around about 1.7%. And probably, if you have a look at it, the concern that's always been with Seven West as well has been the debt level that they've had. They are finally getting that back down. We see actually operational costs dropping over the year, down around about 1.5% to just on around about $1,400 million. And that's actually a good result coming out of them. And for that reason, we've probably seen a fairly positive return. They've also got an NPAT slightly ahead of consensus. However, obviously, as he just alluded to in that package, the one thing that most people are still concerned about is the newspapers and the magazines. And the guidance that they've given is very, probably the best word to describe it is messy. They know that the free-to-air TV market is still very short-sighted in terms of the advertisement dollar. And once we're clear of the election, they do see that there is a bit of a flatlining effect in those advertisement dollars. So the market's probably responded to the better than expected dividend of around about sort of 6 cents, but also the better than expected NPAT. But guidance is still very messy and very blurred as to how they're going to improve that over the next 18 months, James.
What about Fairfax, Evan? We saw them narrow their loss. I think it was a headline around about a $16 million loss. How have they fared?
Yeah, and having a look at the underlying sort of net profit, it was actually slightly better as well at 99.6, disregarding that major sort of provisional write-down we had. The result, the market again is sort of slightly popped on Fairfax. They're up as well today, up around about 1.8% when I had a check before we came on air. That's not a bad move from Fairfax. We do understand where they are at. In saying that, again, I'd probably describe the result as messy, and that's probably, again, getting back to what we've seen over the last year. They have been well and truly behind the 8 ball with getting themselves onto the digital screen. That's probably the other reason we're actually seeing them up, talking about digital. Their current mastheads in The Age and also the Sydney Morning Herald are seeing fairly good uptakes in terms of their digital subscriptions. They've seen a 73% uptake so far and expect to reach around about 150,000 subscribers by this time next year. Now, that will probably mean that their current FY14 guidance will get stronger, and that's why we've again seeing a little bit better results from the market. But all in all, a fairly messy result. Revenue was down 8%, and the first 6 weeks of 2014 are down 8% as well, as they continue to come under a fair amount of strain from across particularly their print and their regional businesses, James. And
just finally, Evan, APN News and Media, they were out late last week, and from memory, pretty welcomed by the market.
Yeah, really good pop, up around about 20%, and it's not surprising. They found first half net profit was up around $1 million to 16.2 for a size of APN. That's a really good move. We've seen net income also up around about 3% to $12.8 million. One thing that is interesting out of it, they are looking again at talking about divestment, particularly from brand executives. That would mean some money coming back in, and that's what we need to see. So we'll see how APN goes, but a good little pop out of the stock.
Appreciate it. Thanks very much. A little bit more on the results and some of the other movements in the space, of course. So let's bring back in James Manning from Mediaweek. Want to get to the reports in a minute. Firstly, though, executive movements. Peter Meakin going to 10.
Yeah, look, most people very surprised by this. You know, Peter had sort of semi-retired from Seven, if you like. He was working as a consultant, but apparently still under the same deal he'd always been on, we'd been led to believe. Up and has been signed to 10. People are seeing that, well, is this going to go the same way that James Warburton did? They're locked in a dispute now about whether he has a anti-compete clause. He was talking, I think, on Friday and Monday that he thought Seven might let him out of it and he could go and start work straight away. Doesn't seem to be the case. Then he thought, well, maybe it was 6 months. The Seven camp saying, no, look, it's actually 12 months and he won't be allowed to start. So could get a little bit messy. But, you know, some people at Seven were very surprised. You know, he'd been on strategy sessions relatively recently. So there's probably good reason Seven don't want him to jump to the opposition. Good
move, though, do you think, for 10? I mean, this is a man who's been
if they
a
get
guru
him,
of the industry.
look, he's got a great news sense, you know. So if they can get him, it could be good. But they're not a traditional news channel, so you know, I'm just not sure what direction he'd take them in.
Let's head back to the general health, if you like, of some of the big players. Just hearing there from Evan, kicking off with Fairfax. What did you make of the numbers?
Yeah, I didn't think they were too bad. I mean, if you read the Australian, Fairfax is all but out of business, you know.
Right.
but no, they've still got some underlying good stuff happening there. I mean, I like the debt going down. You know, they'd wiped a lot off that. It's down to about 154 million. You know, for a couple of years ago, they had a great pile of interest they were paying every year. So that's good of it. The Emma readership, we've just been talking about it. Look, they've got the biggest masthead in the country, the SMH, across all platforms. So that's good news for them if they can, you know, start to monetise that. Greg Highwood talked about new revenue opportunities and Domain, some life there in that real estate sector. So that's got to be good news for them too.
And just finally, Seven West Media.
Yeah, look, the things I like there, what they're doing, new media, the HBB TV.
Yeah.
They signified they announced May next year they'll be piping some content down the broadband too. So that takes them into a whole new realm. They can become, you know, a separate subscription TV company if they want to. It's just unlimited opportunities there. They talked about their major properties and the 7 catch-up, Plus 7. It's the #1 app in the App Store this week. So that's going to start getting some real big eyeballs soon on really adding to the TV audience they already have.
All right. On that note, we are going to take another quick break. Coming up, though, we'll find out why Foxtel won't be renewing its carriage deal for TV1.